Hello and good afternoon. I welcome you to today's weekly market outlook for Admiral Markets on the 22nd of February 2019. It's Friday, and my name is Klatt. I will be the moderator for the upcoming around 45 minutes, and I just hope to present you some thoughts, some interesting ideas on my view on the markets for the upcoming week. So in fact, I can already say that probably it won't be so spectacular, um, especially for some of the most trading assets here, like the DAX 30 or also the Euro USD. And this has to do with the fact that not only in the next 30 minutes, but in the upcoming week, in the upcoming 5 days of trading here, the economic calendar is quite thin, but also that we have on the 7th of March, the ECB meeting here with their rate decision. And so far, no one really knows in which direction we will see the rhetoric go from the ECB. Before we go into further details, by the way, first of all, we have to have a look here at the risk disclaimer. I'll do a small introduction, and then we'll have a look at the markets. So first of all, the risk disclaimer here. Trading with financial instruments offered by Admiral Markets carry a high level of risk, which is not suitable for all investors due to their complex nature. And before entering into a client agreement or making a transaction, please make sure that you read the terms and conditions of the service from Admiral Markets. In this context, it's also important to note that you probably have a view into the so-called KID, the key information documents here. For further information on the risk disclaimer in general, was only the first 3 sentences which I just presented here to you. Please reach out to the website from Admiral Markets and get any information there. Respectively, contact Admiral Markets directly. The infos on the contact details on Admiral Markets will be presented here in a few minutes on a separate slide. Regarding the risk in terms of trading, what we want to do, nevertheless, is have a look at the differentiation now between retail clients and professional clients, and the adaptations which are in place since August 2018. So there's now a leverage restriction when it comes to retail clients. Here is a maximum of 1 to 30 for Forex majors and 1 to 20 for other currency pairs, cross pairs like GBP Australian dollar, for example, or CAT JPY. From time to time, we have a look at these currency pairs here in this weekly outlook too. Especially CAT JPY, for example, was the last we had a look at due to a very interesting seasonal pattern, which played out again, and it's really fantastic. That's nevertheless only a pattern which is in play at the end of January, but nevertheless played out again, played out in 87% of the cases before in the last 20 years. So it was 20 out of 23. And that's why I also mentioned other currency pairs here. I'm mentioning such a exotic currency pair like CAT JPY, but also CFDs on indices and gold have a leverage restriction now of 1 to 20 here. That is true for the DAX, which we want to have a look at, but also gold, for example. Nevertheless, it's not the case for professional clients. There you see that you can still trade with a leverage up to 1 to 500, for example. The interesting thing for retail clients is the negative balance protection, which means that there's an unlimited protection against negative balances. And this is an offering which makes Admiral Markets special to some extent, let's say, but also worth to give it a deeper look here. There is an negative balance protection also for professional clients up to £50,000 according to the policy from Admiral. So for further information on that, please also feel free to reach out to Admiral Markets directly. So this is me, the face to the voice you're currently listening to. And it's not only the treatment of professional clients in terms of negative balance protection, which is making Admiral Markets interesting to look at, but also I'm located in Berlin. By the way, Admiral Markets is a global provider of financial services, so that means later slide, you will see where there's some locations, offices from Admiral Markets, but one is also here in Berlin, Germany. This is the German office, and I'm located in Berlin, Germany too. And so, well, you probably wonder why Admiral Markets, and what I can say from a personal experience, respectively, personal discussions with traders, also professional traders. Admiral is offering a highly competitive DAX 30 CFD offering, with a typical spread of 0.8 points during main trading hours. Very competitive in terms of execution speed, for example, positive slippage on all this. So this makes Admiral Markets definitely interesting to have a deeper look at. But the same is also true for FX. So, for example, there's now a highly competitive offering on EURUSD, for example, with a typical spread of 0.6 pips. Also, further information on this, you find everything available on the website. So here is the one world with global offers from Admiral. So it's not only that Admiral Markets is FCA regulated, but also, for example, there is holding of an Australian financial service license, the so-called AFSL. Admiral Markets Pty Limited. So also interesting probably to have a deeper look at. Further information can be found on the website. I refer to contacting Admiral Markets directly. Feel free to do so. So send an email, contact them via phone. So here are the contact details. And that's it on the introduction. On the host here of this webinar today, Admiral Markets, we'll want to have a look at here at our agenda, what we want to have a deeper look at. So the questions we want to answer are: what are the key economic events in the coming week of trading? One special thing, by the way, it's not that it's a game changer or something or really spectacular, but nevertheless worth note, or it's noteworthy. Next week is the first Friday of the month. It's the 1st of March, but this is one of those cases when there is no publication of the non-farm payrolls. So these will be, usually they are published on the first Friday of each month, but next week is a special Friday. They are not published, but the NFP release will be on the 8th of March. Nevertheless, there are some several other economic events which could be of interest. Not really. I'm not really happy to say that, because I think the main driver for the markets, also starting from the next week onwards, will be the ECB rate decision, and this this decision will take place on the 7th of March. Nevertheless, we want to have a look here at the ISM, for example. Probably this will have some impact on the markets. We also want to answer the question around the current bias in the FX, equity, and commodity markets here, and then also the question which probably arises here regarding trading opportunities which may arise. There's right now, very interesting a trigger which we are focusing in gold. So in regards to gold, let's probably start here. There we are today not looking at the 4-hour at the daily chart, but we look at the 4-hour chart. And why do we look here at the 4-hour chart? Because the thing is that when looking at the daily here, you can see that we are now trading down to a region which we made already a topic several times before, 1,223, 1,225 USD per ounce. This is the former highs which were broken at the beginning of the week. That was already on Monday. It was a thin market environment because of the bank holiday in the US there, the so-called President's Day. And now the thing is that from this perspective, you probably just say, okay, well, I'm going long against this level, and I'd be a little careful here. So it's still true that gold, not only from a technical perspective, is really interesting, also midterm here, but also gold is interesting from a fundamental perspective due to rising recession fears. These started already last week with a very bad reading regarding the retail sales. I mean, it's only one data set. It was for December. Nevertheless, it came out at the lowest level since 2009 here. And in combination with several other fundamental readings, which came in below expectations, let's say. There's also the city surprise index, for example. I'm looking at the economics events being published, and then looking here at the surprise factor they come in, and this is already showing that there are several surprises on the downside. Not that this is per se something negative, but it's a good indication of illustrating us that there is right now some pressure building. And the current move higher, for example, in US equities is mainly driven due to speculations rising, for example, on another round of QE probably of the Fed. So how can I say this? Well, let's put it that way. When looking, and by the way, I've prepared 3 tabs, in fact, and I haven't prepared the one which I'm now trying to refer to, or which I will refer to. It's the Fed Watch tool. So just let's wait. This is showing or giving us a probability currently played at the CME here. And when looking at it, you will see that it's not only that markets are not expecting a rate hike in 2019 anymore. So this is down from 3 we expected at the September meeting, but it's down to 0 for 2019. No more rate hikes expected from market participants, but it's now also that market participants start to prepare for a rate cut. And 1 second. So here you can see the countdown to the next FOMC decisions in 26 days. It's in March. We will also refer, by the way, to the Fed minutes from Wednesday. But before we have a look at this, we want to look here at the Fed Watch tool. And by the way, you can now see why it would have been a great idea to prepare this already, because it takes a little to load here for whatever reason. So usually it's not a bandwidth problem with my internet. But let's have a look at December 2019. So we don't look at those events, but you can clearly see here there's no real speculation that there will be a rate hike in March anymore. But when looking at December, you can see that it's not only that markets are by nearly 5% expecting a rate hike, but here rate cut speculations are rising right now. And this is mainly probably due to the statement from the Fed minutes from last Wednesday. It's not that we didn't see that coming, to be honest. After the reading in January 3 weeks ago, there we saw that there is now a higher flexibility when it comes to the balance sheet runoff. But now in the Fed minutes, it became also clear that there was a widespread agreement among FOMC members to end the reduction of the 4 trillion USD balance sheet by the end of the year. And it's also true that this Fed minutes stated that the FOMC members were unsure whether any adjustment in terms of rates would be needed in 2019. So with this in mind, it's not clearly stating, yes, there will be a rate cut, but nevertheless, between the lines, you can clearly read there's some skepticism around the economic outlook of the U.S. And let's face it. I mean, when looking at the rate cut right now, after a series of rate hikes over the last months, or over the last year, for example, the next step after rate cuts is a QE. And let's also face it, the ECB, for example, we'll look at it separately in a few minutes, but the ECB hasn't even considered hiking rates. And when looking at the last minutes from the ECB yesterday in the morning, it was published, they are already off the table for 2019. So there was some speculation for 2019 that the ECB will hike rates. This speculation is already off the table. We are starting already again to talk about TLTROs. This is targeted long-term refinancing operations, which didn't play out that well, in fact. But the fact that right now the voice is growing louder, that there will be need of another round of TLTROs is showing that the already anemic demand, or also supply, that depends on which from which way you near this topic here, or from which direction you're coming, let's say, and nearing to the topic. But the thing is that there's already an anemic demand, but also supply. Not supply. I mean, there's enough liquidity, but demand when it comes to the private sector demanding loans here, and it's perfectly illustrating that all these rounds of QE and these enormous sums which were pumped into the financial system didn't have the effect you need to talk about sustainable economic growth. This is especially true for the European Union, but also to some extent for the US here. And looking at those numbers around the employment situation, for example, well, they weren't that fantastic. I mean, when looking at the numbers which were presented, everything looks beautiful. But to be honest, there hasn't been strong, in my opinion, at least, let's say, there hasn't been a strong development in regards to the earnings, for example, average hourly earnings, for example. Yes, there was a positive momentum being picked up over the last numbers which were presented, but nevertheless, there was a quite long period where these numbers just showed that jobs were created in a sector where you shouldn't really expect numbers like average hourly earnings picking up significant momentum. So we're not talking about a full-time employment, but we're talking about half-time or half-time employment or bartender jobs. Let's put it a little more bluntly here. And when looking at these numbers, it's not coming as such a surprise that there is fears around a recession forming at the horizon. So when looking at this situation, now let's come back to the current trading situation. When looking at these numbers, we know that gold is usually a good performer in such a market environment, and usually you should expect gold to pick up momentum. Nevertheless, even if the fundamental picture, midterm picture, is positive, you should be careful to some extent to go aggressively long against these levels here, because there's also a chance that probably we are completely wrong, and it still takes some time if some fears manifest here, and if or when U.S. yields here start to sell off again, and that said, carefully, or when looking at this chart here, you probably should wait for a sequence of higher highs and higher lows, which forms here, and then try to use such a sequence and a clear sign of now the gold losing momentum here on the downside again, and then taking this as a chance to anticipate a break higher to new yearly highs in this case first, and anticipate an attack of the 2,360 region, which is, by the way, crucial not only from a 2017-2018 perspective, but also, and hopefully it's not that perfect because it's not. Oh well, it is perfect. Look at this. This is a weekly chart, and it's enough data we have available here, which is beautiful, because now you can see how significant this region is. So we're not only talking about 2017, but 2018, but we're also seeing it to be a region which was already in play in 2016 and already in 2014. And when seeing the significance of this region, you can also see that the bounces from this region became smaller. So we are looking currently here at the weekly chart. So please excuse this, but I do not plan to adopt this right now, but use it here. But just look at it from a wider perspective, and what you can then spot is you can spot signs of supply. I'm sorry, not supply, but demand coming in earlier and earlier and earlier, and the bounces obviously not being as aggressive as they were before. So when looking at, for example, the bounce in 2016, you can see we bounced from 360, 370 here down to 1,130, and this, by the way, within months. So that was in August when we made these highs here, and then by December we traded as low as 1,100 around here. That was also due to the Trump election, due to rising USD, due to rising yields and all this. And then we recovered quite positively, and we saw another bounce that was in 2018, but this only pushed us as low as 1,170. Why do I mention this? Well, it shows that the supply coming in around 1,360, 370 USD per ounce is obviously diminishing. It's becoming less and less supply here, while the demand comes in earlier and earlier. And we are looking at a very long time frame. So this is a weekly chart. So which means the significance of this region here is not only given, but it also shows that it seems only to be a matter of time once a break will occur. And now the thing is, and why do I mention all this right now? So we're talking about the daily chart going down to the 4-hour chart, and now we're looking at the weekly chart. Why is this noteworthy? Because it could be a long-term trigger once we make it above 360 to 370 here, which could result in enormous gains, short-term gains, and which also perfectly fit the overall fundamental picture. Let me just do the following. So this is purely technical right now, but it gives you an idea of why this is very important or very interesting, let's say. It's not important, but interesting. So when you look here at, could this please move? Yes, there we go. So what you usually do is to project the target on the upside. You can use the bottom of this formation, of this, in this case, by the way, rising wedge. This is how we call this. And then you duplicate this these highs here to the low of this formation. And once the breakout occurs, which hasn't so far, but nevertheless it could rather sooner or later, what you see is that the projected target can be found minimum around 1,670 to 1,700 USD per ounce. So again, it's a weekly chart, and it will probably take some time. But when combining all this and looking at this formation, you see that there is for midterm gains in gold, the picture looks very bright. It's a very positive picture, and from a risk-reward perspective, and this is what it all comes down to. I mean, we can probably see a complete different picture here. But what's interesting, in my opinion, is that from a risk-reward perspective, this is getting really interesting, because now, and then we delete those lines again here. When you're looking for anticipate such a break higher, then the region here, in my opinion, which we currently trade to, around 320 to 220. I'm sorry, by the way, it's 3. It's not 2. I'm sorry. So it's 3. So then this region is, in my opinion, a very interesting one, because we clearly see when the bullishness is not given anymore. This is once we drop back below 1,300, 302 USD. So this is a clearly stop out level. And then if you go long against this level, that means you have a risk of something like 20 to 25 USD per ounce. So unleveraged in this case, and you're aiming for a push up to 1,360, which is already delivering a risk reward of 1.5 to 1, 1 to 1.5 to 1 to 2, which is already really interesting. And probably this entry here in this region could act as a first attractive scale into a position which could grow larger and larger once this break of 1,360, 1,370 really occurs on the upside. And that's why I'm somehow a little excited. Is probably too strong, but it's a really interesting region in my opinion, and it's definitely worth to give gold a deeper look here, because from a risk reward perspective, also for longer term engagements, it's getting really interesting right now, and especially when looking at the current situation and also equity markets. So therefore, we can also have a look here at the Dow Jones, for example. We see a nearly V corrective move, and this is, again, I already mentioned this last week. In my opinion, it's a manipulated market right now due to all those comments made by the Trump administration, by U.S. Treasury Mnuchin, for example, around the plunge protection already between Christmas and New Year's Eve. The Fed now acting very, very dovish, not only bringing down speculations around the rate hike in 2019 to nearly zero, but also talking about the flexibility in terms of their balance sheet runoff, for example. So when looking at all this and also reading between the lines that a rate cut is likelier than a rate hike, and the next step beyond this is a secure program, we also know that this is surely short-term bullish for equities. But, and this is also true, it's also short-term bullish for gold, especially because it usually results in a sharp decline in the US dollar, which you would then expect. So when looking at this picture, I think this is also another hint towards a very, very dovish stance from the Fed. And now things, in my opinion, are getting really interesting. And this is something you can also see already to some extent in the technical piece for today. So today, there are some speeches from Fed members, voting Fed members here. So I snapshotted the economic calendar here from the website from Admiral Markets. You can find it yourself, by the way, here, going via analytics to the Forex calendar. And, well, the thing is that now, and there you can see the headline, we're referring to dollar JPY. And why is dollar JPY interesting? Well, we've drawn a very interesting bullish picture for gold right now. And so what you can also see is when going here to the dollar JPY, yeah, today we're drifting again towards 111. In my opinion, this comes with a surprise. So to be honest, you do not expect this, especially when looking at the performance from gold over the last days. And there's something I prepared here already. So with this add-on package, what you can do is you can have a look here at the correlation between certain assets. And in this case, I look at the correlation between gold and dollar JPY. And you can see here on a daily chart over the last 1,000 bars. So we are looking at 1,000 days of history here. There's usually a strong positive correlation. So we're not looking at the small time frames. So we're looking at the bigger picture here right now. So the interesting thing about this is usually you just do not expect dollar JPY to trade back towards 111 while gold is eyeing such a crucial line of resistance on the upside. Probably you expect to some extent such a development here, such a decoupling of the correlation in the smaller time frames, but I think we are now starting to enter a zone which is raising some questions, let's say. So why do I say that? Well, what you can see, what you can clearly spot here is when looking at the developments in 10-year yields. So this is a daily chart, but we can also look at it from a 3 to 6 months perspective. 1 second, please. There we go. So it's 6 months here. And so now what you can see is there was a clear positive correlation between dollar JPY and gold from October onward. So we topped out around 325 basis points here. That was a multi-year high. We haven't traded as high as 3.2, 3.3 around percent on 10-year yields here since 2011. And then we started to sharply drop here. And that was due to the Fed. That was due to the volatility in equity markets over the third quarter of 2018. And then we bottomed out here. That was right at the beginning of the year, and we traded back. It's not a sharp bounce back, let's say, because we are only talking about 20 basis points. We traded as low as around 2.55% here, and then we bounced back to 2.75. So it's 20% basis point move. Nevertheless, the thing is that from here, that was it was around 1 month ago. It was on the 15th to 17th of January. We topped out here and now started to trade lower from here. You can see this, right? So also here, we are not talking a big move. It's only 8 to 10 basis points. No big deal, but nevertheless, it was enough, in my opinion. 1 second. Where do we have it here? It was enough to push gold higher, significantly higher. So let's have a look here. That was a stabilization from the 4th of January till the 17th of January. So there was a stabilization at an elevated level, and then we took off again into the end of January. Sure, it's a very positive seasonal pattern or seasonal window for gold in general. So usually the end of December over January till the first 2 weeks of February are usually considered bullish for gold from a seasonal perspective. And there's charts, you could easily show this, that this is really in fact the case. We made this, by the way, a topic in several weekly pieces, technical pieces, and also we're capable of, to some extent, profit from this move here. But now the interesting thing is, while you usually see gold taking off and doing exactly what you should expect gold to do here, while yields dropping, that gold takes on bullish momentum. Well, what we didn't see was pushing dollar JPY lower. Yes, sure. Well, we stabilized here, and then we saw a sharp, or that wasn't a sharp, but it was a drop lower into the end of January. But then we took off from there. From 108.50, we pushed as high as nearly 111 and 20 here. And this is a very interesting development, because based on what I just showed you here, this correlation table, long term, you don't expect JPY to weaken in such a market environment, especially not against the US dollar. And so this is something noteworthy, in my opinion, because it shows a decoupling, which rather sooner or later will probably where the correlation decoupled, and where rather sooner or later the correlation will pick on again. And in my opinion, it will be a move in dollar JPY lower instead of dollar JPY really pushing higher. Sure, that you could easily bring up an explanation for this picture here. For example, how Hiko Kuroda, the BOJ governor, was quite dovish in some of his remarks here last Tuesday. Yes, was Tuesday. Well, he said that the BOJ, the central bank, was ready to ramp up the stimulus here if sharp yen rises, for example, start to hurt the Japanese economy and derail the path towards achieving its 2% inflation target. Nevertheless, it's not enough. And by the way, it's only 2 to 3 days ago. It's not capable of explaining why over the last 2.5, 3 weeks, dollar JPY, respectively JPY in this case, lost against the US dollar. That's just not enough. It's not getting the job done, let's say. And this is definitely something to have a close look at here in the upcoming days. And it wouldn't come as a surprise not only to see gold taking up again, momentum again, and then going for another test of these highs, respectively attacking 1,360 here on the upside, 360, 370, but also seeing dollar JPY push lower. The only problem when looking at dollar JPY, surely something to worth noting here, is you have a negative carry. So when holding a position, dollar JPY short, for example, you have to pay a price for this. So timing is very, very important, which where technical analysis comes into play. Probably it's still too early to look for a break. Again, we could be clearly wrong, or I could be clearly wrong with my view here in the market. But I definitely start to get in where it definitely gets interesting once we push back towards 110.20, respectively. Go for a dip below 110. Then I think dollar JPY should be carefully watched, and then we have to see how things develop here. So yeah, that's it on dollar JPY and the overall picture. Now let's have a look at euro, respectively the DAX, and probably also have a look here at the ECB. Again, I'm not very, very positive for the next week of trading when it comes to volatility. This is not only true for Euro USD, and here, by the way, we'll also have a look at the chart and see nothing really changed over the last days, but it's also true for the DAX. And if I expect anything from the DAX, then I expect it to trade higher, drift higher, as it did, for example, today. So all in all, what you can see when looking at the lower time frames, you can see that the overall market environment seems to be very, very thin right now. And there's no big volatility taking place right now. And if it takes place, then you see spikes on the upside. That has happened several days in the past, over the last days. Today again, by the way. So currently, in fact, I'm holding an intraday long position in the DAX based on my opinion. So it's not only that I'm talking about it, but I'm also holding a position in it. But let me just show you here, for example, those spikes higher. That was around the opening, for example. That was on the opening yesterday, shortly after the market opened. That was around 8 a.m. German time. Very thin already, because between 8 to 9 a.m. There's usually the future DAX open. This is not really correct anymore, because since the 10th of December, we are now seeing the future DAX being traded from 2 a.m. German time onwards, overnight also. But the bigger volume, let's say, from institutional side pours in at around 8 a.m. German time. So this hasn't changed. There was a push higher, which was then sold off again over the day. Well, we stabilized, didn't really push lower. But it happened several times already before. For example, here, this is an open range example from Tuesday, in this case. No, Wednesday, I'm sorry, it's the 20th, yeah. It was also a sharper push higher. We sold off again to new daily lows and then drifted here higher into the evening and back above 11,400 points. And the same is also true here on, in this case, Tuesday, yeah, was Tuesday, the 19th. Also here, push higher, thin market environment, sold off again, pushed again higher, and sold off again. So these are signs that the market is having difficulties taking on momentum on the upside. Nevertheless, there's obviously a willingness to push the market higher instead of lower, because the market can't really take on momentum on the downside. That's especially true when looking. Oh, I'm sorry, I haven't prepared this chart. That's not good. 1 second, please. So that's a breakout level here. By the way, we can also take out these levels. These are not really relevant for us. So yesterday, you could clearly spot there was demand coming in against, let's make it a round number, 11,400 points over and over and over again. We didn't really push lower, which is a positive sign, and could also be used to probably draw a bullish picture for today. So there you can see it here. And this is, by the way, now the line in the sand, 11,400 points. Every push below that level would negate this sequence of higher highs and higher lows. Nevertheless, the question surely arises, where should the pressure come from? So first of all, the Fed minutes delivered to some extent a put on the downside. We can clearly say it that way, because they delivered no reason for market participants now to become skeptical about the willingness of the Fed, respectively also to some extent the ECB. This is something I will explain in a few seconds. But regarding the Fed, so there's no real reason to not believe that they will stand up once the market sees some turbulences, which means there is no real downside right now in the market. And this means that you shouldn't really expect big pressure to build up here if there's no real big external event hitting the markets right now, which is difficult, in fact, because just look at the developments around the negotiations, trade negotiations between the US and China, for example. Perfect example. Once there is only a small dip in the market, you can see a White House administrative, let it be Donald Trump alone or Mr. Kudlow, the chief economic advisor, for example. So what you can clearly see in this moment is there's then the talks are going well. Boom, you have somehow a put in the market, and then it takes off from there again. So it looks really manipulated, but on the other hand, you have to just in this case swallow it, let's say, and just accept that the market is to some extent manipulated right now, and this is reducing potential on the downside enormously. So if you want to be positioned, then I think it's definitely better to be positioned on the long side instead of the short side right now, because the market just does not have any kind of real risk aversion or anxiety or whatever, which is capable of really pushing it aggressively lower right now and result in a sharp intraday downtrend. That perfect example was, for example, yesterday when looking at the DAX and seeing that we could easily, put this in quotation marks, but to some extent was quite easy to stabilize then against 11,400 points. The target, by the way, on the upside stays around the December highs of this drift higher. So not that you get me wrong. I'm short-term bullish, yes. Intraday engagements on the long side are definitely to be favored in my opinion. Nevertheless, I'd be really, really careful to see the overall bearish mode in which we still in the DAX to see it broken. This definitely needs time from a pure technical perspective. We can probably start to think more bullish again, also from a longer term perspective, if we can make it back above 11,600, probably 11,700 points, but also we have to see the fact that we are still trading below the SMA, the simple moving average 200. This is the purple line here. And as long as we trade below that, is the long-term trend should be considered bearish. So it's still only a bear market rally if you want. I'm sure the ECB can change that. And here now let's have a look at the ECB itself. So the ECB minutes yesterday from the last meeting in January on the 25th, I think, if I'm not mistaken. It was, we know that the ECB policy makers here took a gloomy view on the Eurozone economy. And they asked, in fact, and this is what the minutes also underlined here, they asked for swift preparations for giving banks more long-term loans, which means those TLTROs I already mentioned. The thing is that the DAX is already expecting this. It's also clear that the rate hikes are off the table for 2019 when looking at those numbers, or at this statement. Nevertheless, the thing is that I'm not really seeing a more dovish stance of the ECB. And the question here is then, probably it's enough to currently, in a thin market environment, push the market higher, the DAX, which is also why I favor long engagements over the next week, also from an intraday perspective, and a drift higher. Nevertheless, I don't really see how such a topic like talking about TLTROs or not seeing any rate hikes in 2019 anymore, how this can then accelerate a more aggressive push on the upside here. I think this takes definitely more from the ECB. And the question is, can the ECB really deliver that without risking their reputation and also facing the fact, that's also something we have to remember, that they are still in a very difficult spot here when it comes to the current economic situation in Germany, for example. Also something which Draghi emphasized several times over the last meeting, and when journalists asked him. By the way, in this regards, probably we should have a look here at the data set which was published today, the IFO. But unfortunately, it takes a little. 1 second, please. Let me just see. There we go. So there's the tweet making this a topic here in the morning. So it's the IFO, which showed the German business confidence falls more than expected, not dramatically, but nevertheless, it was this, and this is more important, it was the weakest reading since December 2014. And it was also that there were declines in the current assessment and the expectation component, with both components below the forecast. It's only one set of data, so no big deal. Nevertheless, worth remembering that here the overall economic outlook for the German economy worsens, and more and more and more and more. And this is definitely something which also most likely holds the ECB back in regards to a rate hike, and probably forcing it to renew some kind of QE speculation. Nevertheless, also on the other hand, I think the situation is not bad enough right now to justify another, let's call it another bazooka from the ECB then on the 7th of March. And this is definitely something which then will definitely hold back equities of pushing aggressively higher, but it's most likely that we will drift higher and then just have to see what the ECB delivers and especially how the markets react to it. The same is, by the way, also true for the euro. When looking here at the euro USD, we can see that the picture is still the same as the days before. We are trading, well, weeks, months before. We're trading within a range between 112 to 116. Yeah, and just have to see in which direction the ECB delivers. We shouldn't expect big volatility to come then in the days to come, the next week of trading. So the most interesting correlation right now, definitely, in my opinion, is dollar JPY to gold. This is definitely something worth watching, worth analyzing. Also because especially gold, for example, delivers a very, very attractive risk reward, in my opinion. And yeah, the euro probably we should skip any engagements over the next 2 weeks, let's say, and wait for the ECB and then see in which direction not only the ECB delivers, but also in which direction euro, in this case on a broad scale, but also and especially against the US dollar, reacts then. So yeah, and that's it from mine. So I wish you a nice weekend. Enjoy yourself. I hope you had some aha moments, let's say, and it was interesting. Would really appreciate your feedback on YouTube. The recording will be available in a few minutes to hours, and that's it from mine. So enjoy yourself. Have a nice weekend. Talk to you again next week on the then 1st of March. 2019. I really look forward to it. See you. Talk to you. Bye-bye.